In this video, we are going to address ourselves with valuation framework, also understand how to value any company or an asset. Now, any asset or a company will always have a market price to it, which means if you go out and buy a laptop, be it for personal use or for business use, if I go out in secondary market and purchase shares of any company, so it will also have a market price to it. But the question turns out to be, is the market price of that asset or company is same as the value of the company? The answer to that is no, it is not. Now, it is always better to actually identify value of a company or the asset before you decide whether investing or purchasing that company or an asset is a right decision for you or not. Now, for that, you are going to follow some kind of a metric, which generally the finance personnel or experts follow. Now, the valuation concept can also be applied in the day to day business decisions as well. For instance, if a company is actually planning to purchase 5 laptops, which will help the company to render the services to its clients. Now imagine that the market price of each and every laptop is 60,000 rupees, which means the price of those 5 laptops will be 3 lakh rupees. Now this 5 laptop is priced at 3 lakh rupees, which acts as current market price of the asset. The question turns out to be whether for the business house, this investment of this 3 lakh or the purchase of these 5 laptop at this price is correct or not, is right or not. For to identify whether the business decision to buy this laptop should be a yes or no, you need to have a comparable for that. And that comparable is actually the intrinsic value or the value of the laptops for this company. Now, in this case, as we said that the company will be rendering services to its clients where its employees will be using those laptops. To identify that, you will have to estimate something what the company will get from the laptop. Now, you can think that if the company is having this kind of a laptop, and let's say the company has already planned that they will utilize these laptop for 1, 2, and 3 years down the line. Now, of course, these laptops are going to help the company to generate economic benefits. When I talk about economic benefits, what do we mean by that? The economic benefit is actually the monetary benefit we are talking about, money in any currency wherever the business is actually working. So this laptop will help the employees to generate services to the clients, which ultimately the client are going to pay back the company in the form of the client service fee, which means for the company, those payments coming from the client will be act as sales, or we can say revenue generated by the company. Correct. Now, those sales and revenue will, of course, include the cost of employees and other costs, and also will include the services generated from those 5 laptops as well. So ultimately, we can see that this asset, which is laptop, is helping the company to generate economic benefit in future. So I can say this is acting as future economic benefit. Now, let's say that the company is planning to renew its resource, which means laptop, after 3 years. So we can say the utility of this laptop will be for the first year, second year, and third year, which is already mentioned here 1, 2, 3. The company estimates and identify that the utility of those laptops in each year will give them 1.2 lakh rupees for the next 3 years. So at the end of one year, we can say the company generates 1.2 lakhs, 1.2 lakhs, and 1.2 lakhs. Okay, so these are the amount which the company is expecting to generate. Now, this 1.2 lakh rupees cannot be actually directly compared with the uh, current market price of all these laptops. So we can see that 1.2 plus 1.2 plus 1.3 makes it 3.6 lakh rupees, and the cash outflow for the company to purchase or to have those access of those 5 laptops is 3 lakh rupees. So I cannot directly compare them, that which is 3 lakh rupees compared with 3.6 lakh rupees, and say that it is good decision to purchase this laptop. Now, for these future economic benefits, to make it comparable with current market price, we need to bring the future prices or the value to the present value terms, which means discounting them, right? And to discount them, we will require to have something called as discount rate. And that discount rate, which is basically the rate at which the future economic benefits will be discounted to the present value terms. Now, once we have all those present value of all the future economic benefits, that present value of future economic benefits, this will be called as the value of the asset in this case, which is laptop. And again, that will be used as a comparable whether to make an investment or whether to purchase these 5 laptops or not. So in this case, let's say when by using a discount rate, the company estimates that present value of future economic benefits is turning out to be 3.2 lakh rupees. And we can say this is, since this is cash inflow, so this will be in positive value. 3 lakh rupees is negative, which is 3.0 lakh rupees. Effectively, the company is generating money from that, right? So we can say the value of the assets for the company is actually 3.2 lakh rupees, whereas the market price of the laptop is 3 lakh rupees. The value of an asset is 3.2 lakh rupees, whereas the market price of all those assets, which are laptop, is 3 lakh rupees. So that means the price is below than the valuation of the assets. So the decision should be buy in this case. The decision should be purchase all those 5 laptops for the company. And this is how generally the decisions are also been taken. Now, coming back over here, when we talk about estimate the future economic benefits, which is step number 1, related with the same thing as we had done for the laptop. Now, in the case of the companies, we assume that there is no restricted life as it was in the case of asset, which was for 3 years. In this case, in the case of valuation, we assume that the companies are going concern. Why is it so? Because for the foreseeable future, the company will keep on doing their own business, right? Estimating the future economic benefits for all the foreseeable future, and then use the appropriate growth rate while estimating the future economic benefits. Means in this case, as the future economic benefits were constant, that would not necessarily be the case in the case of companies as well, right? So the future economic benefits can be growing or decreasing, it could be constant, it could be different in each and every of those years, and that's what also need to be incorporated while estimating the future economic benefits. Step number 3 would be identifying the appropriate discount rate. So as you require to discount all the future economic benefits, so basically bringing them, what will be the rate at which you will require all the future economic benefits to bring them to present value terms. So that will be used at discount rate. And of course, discounting all the future economic benefits in present value terms using the appropriate discount rate. And again, depending on the technique which you are using, which is depending on the technique you are estimating the future economic benefit, it will determine what type of discount rate you are going to apply. Fifth step would be the PV of all the FEB. So basically, future economic benefits. So let's say if I'm using dividends as an example, if I'm using dividends as my future economic benefits, in that case, cost of equity would be my acting as discount rate. And the present value of all the future dividends are going to be called as the value of the company in this case. And of course, once I have the value of the company, I will have to compare with the current market price of the company and then to decide whether the company is undervalued or overvalued, trading above its value or trading below its value. And after that, the investors or the market participants are going to take their decisions. Now, let's come to the techniques of valuation, which is very popular. It is called as DCF. What does this stands with? Discounted cash flows. DCF is divided into two broad types, which we can say free cash flow to equity and free cash flow to firm. So equity stands for equity owners or firm stands for firm holders. Now, to understand what distinction it plays, let's look at the balance sheet of a company. So imagine that the balance sheet of a company, which in this case is Britannia, the company might source its finance from three different sources. which is equity owners, the one who owns the company, preference owners, all those who are holding preference shares of the company, and debt holders, all those institutions or individuals who have given loan to the company. Now, those are the sources of finance which is utilized by the company, which in this case is Britannia, and apply those finance to purchase assets. And those assets will help the company to generate economic benefits, which means profits, interest, preference dividend for all the three participants, which is equity owners, preference share owners, debt holders. Now, when we look at the P&L of a company, which is also called as income statement, somewhere it starts from net sales and rules down up to EBIT, which is called as earnings before interest and taxes. What is the element which is reduced after EBIT? It is interest. And if we look where interest is paid to whom? It's paid to all the debt holders. What is left out after paying interest is called as PBT, which is profit before tax. And after that, you pay off the tax component. And what you are left out with is PAT, profit after tax. Once you have PAT, then you decide whether you are going to pay dividend or not. And after PAT, if the company already have preference shareholders, this is paid first, which is preference shareholders. And if the company is also planning to give dividend to equity, then this would be paid later, or second case, which is equity debt owners. So in the case of preference share dividend, it goes to the preference shareholders. So the institution or individual who have purchased preference shares of the company. Equity dividend goes to those institutions and individuals who have purchased equity of this company, which is Britannia. So this is the way through which the equity owners, preference shareholders, and debt holders are generally paid off. They are given the returns from the company. Now, talking about the valuation. Now, these DCF, which is FCFE and FCFF, are basically future economic benefits. Now, future economic benefits can either be FCFE or FCFF. So, FCFE basically stands for all the freely available cash flows which will go to equity owners. And if you're using calculating FEB using FCFF technique, it means all the cash flows which will go to firm owners. In the case of firm owners means we are talking about controlling stake, which means it goes to equity, it goes to preference shares, it goes to the debt owners. In this condition, which is FCFF, a company, let's say ABC, plans to acquire a controlling stake in Britannia. Let's say 100% controlling stake in Britannia. That means they want to know what will be the freely available cash which will go to equity owners, which will go to preference share owners, and which will also go to debt owners, because theoretically what they are saying, which is this company is saying while taking a control, that they are going to buy out each and every one of them. I hope you are clear with the framework. If you have any questions, drop that in comment box.